Hey, it's great to be back here on Markets Mindset. And we were talking earlier before you mentioned that from beginning of the year to now, yields on the index are higher.
Yep.
So to some extent, spreads have not tightened as much as yields have sold off. What's going to make spreads widen from where they are? And if that widening is coincidental with yields coming down, is it a zero-sum game or is it not?
In talking with a number of investors over the last couple of weeks here, it feels like everyone feels that spreads are going to go tighter. They reluctantly think spreads are going to go tighter. I think no one is necessarily comfortable with them and want to heavily invest in it, but that's where they think they're going to go from a technical perspective. My view is kind of aligned with that. I do think that, particularly if we stay where we are.
You think we're going to keep grinding it?
I think we keep grinding in. I think that's because, I think we're going to stay where we are from a rates perspective. We're going to see supply not be nearly the same pace that we've seen in the first couple of months here. It will still remain active, but I don't think it's going to be as active. And I think the Fed is going to do their best to try to keep rate vol where it's been. And so on the lower end of the range. And I think those are the three factors that will continue to see spreads grind towards those tights that, we're only 6 basis points off of the tights from 2021. We're only about 10 basis points off of the tights going back all the way to 2005, depending which index you use. And I think those are potentially achievable at certain points of this year.
I don't have to ask you the follow-up question because I bet you I know the answer, which is, are we going to test and break through the tights of the last 5 years?
I think so.
Right. I mean, I think it's important to that question. Like the market feels like it's shifting from a soft landing economic outcome to a no landing economic, which means elevated rates and elevated inflation. So rates will need to stay high just because the neutral rate is going to be that much higher. You're going to see a growing disparity between euros and treasuries or bonds and treasuries. So you're going to see a lot of our multinationals issuing over there to get incremental carry, and that's going to result in even less supply for us in the back half of the year, which again goes to the record tight narrative.
And so record tight spreads. And with that record tight spreads, we've seen the accordion collapse from single A's, double A's, triple B's to single A's and double B's to triple B's. What are you telling your triple B issuers right now? What are they supposed to be thinking as we move into the second quarter?
I think they're supposed to start rolling up the sleeves because, listen, I think spreads are going to get better. But when you have this much liquidity in the system, it masks risks. Colby talked about geopolitical risk, which is out there. We have a commodity risk going on right now, given what's going on in the global economy. And we still have an ongoing deficit risk, where the market is going to ultimately throw the red flag. And we're just not fully pricing in those risks by any stretch of the imagination because of the liquidity backdrop. So take advantage of that.
Well, listen, thank you again for joining us on Markets Mindset. We'll see you in another quarter.